welcome to the OANDA MarketPulse charting analysis video. My name's Craig Erlam, Senior Market Analyst at OANDA. Now this is the final charting analysis video today. This is the video that's going to focus on indices, the prior to on FX and commodities for those who have managed to catch them. As I've highlighted on the previous video, this is a new format which we're going for. We're going to start each week by taking a look at a large number of currencies, commodities, and indices. Take a look at how the previous week finished, how I think that influences the week ahead, whether it changes, and then as the week goes on, we'll release shorter videos throughout the week, and then we'll reflect back on what's changed, picking the currencies, commodities, and indices which have where we've seen some developments, and then I can obviously refer back to this more in-depth video. Let's start today with. Let's start this video. In this video, we're going to focus primarily today on the S&P, the Dow, and the DAX. These are the three most traded indices at OANDA. So I want to focus on these primarily today, and then we will open up to more in the coming weeks for these videos. First thing I wanted to highlight on this weekly chart, given that I've not covered this in prior videos, is this trend line. Now, the reason why this is so important, and firstly, I'd actually like to highlight, it's not your conventional trend line, or it's not what people would typically, not how many people would typically draw their trend lines. We are taking the lows from 2009, so this is the financial crisis lows, effectively. Now, the reason why it's not necessarily conventional is because I've bypassed these first lows that took place in November 2011, and the reason why I've bypassed those is because I don't think they're very indicative of the overall trend. If we zoom out, we look at the trend here, and if we were to join up these financial crisis lows with 2011 lows, the trend line would actually look more like this, and personally I do not think that's indicative of that trend. We've not reverted back to the trend line. Really, when we're looking at these trend lines, what we're effectively looking for, similar to a moving average, is we're looking for the times when the trend reverts back to the mean, and then we see it approach that trend line, and the trend is either confirmed or perceived to be broken. Now, we've not come back anywhere near this trend line since touching that back in October 2011. And therefore, I just don't think it's indicative of the trend line. If we ignore this brief period when we saw some stronger selling than the markets were anticipating, you can see that it touched this trend line. Apart from the first touch, of course, we touched it a second time here, a third time here, a fourth time here, a fifth time here. And if we zoom out and look at this chart, I think this is far more indicative of the overall trend, with the index reverting back to the mean effectively. Now, what makes this trend line so interesting is that it's finally been broken. We finally, after five occasions when the when the index has rebounded off of this trend line. Last week, the week before last, we saw the index close on the trend line. Very bearish Marubozu candle here. The index dropped around 130 points in that week. Very bearish. Of course, that's the first week of the year that we're all very aware of at this stage. The following week, we did see initial rebound off the trend line. Again, effectively a sixth confirmation of the trend line before the index sold off as the week went on and closed the week below that trend line. That's a very bearish signal as far as I'm concerned. Not only that, we had this prior support and resistance level around 1890 to 1900. That was also broken and closed below. Already today, we've seen this provide some resistance. We've seen some consolidation, maybe a minor correction, and that 1819 to 1900 level actually provided resistance. And after providing resistance, the index has actually fallen back down off of this. Really, a couple of key points here, I think, based on today's trading, though. One, we haven't broken below the day's lows, which isn't particularly bearish. This looks more like an indecision candle to me, consolidation. Now, that would make perfect sense given that today is a bank holiday in the US, so trading volumes are typically lower, and especially trading volumes, of course, in the US itself is going to be extremely low. So really, I'm not sure how much this is indicative of the overall market sentiment at this moment. The overall market sentiment, now that we are approaching a very key region in my book, we are approaching 1805 to 1845, a 40-point region in which I think is going to be extremely important for this index. Not only is it a repeated area of support in April of 2014, again in October 2014, and again in August last year, when the market has begun to clearly top, but also you've got what is, I guess, a triple top or a head and shoulders. Personally, I think this is more of a triple top. You've got the it's not perfect by any stretch of imagination, but you've got these three key points here, which I think is the neckline of whatever formation this is, be it whether you want to call it a triple top or a head and shoulders. If we duplicate this trend line, see, it's not perfect, and I'm not claiming it to be. But should we see a break of this trend line, and lead to the break of these price supports, I think this could be extremely bearish, and I think we could potentially see a given how people often trade triple tops or head and shoulders. You take the general rule, or the rule of thumb. Of course, it doesn't work every time. It's just a rule of thumb. You take the move from the previous shoulder or the previous top, which in this case is around 2115, down to the neckline. So in this case, let's call that 1845. So really you're looking at 170 points here, and then you project that below the break of the neckline. So that would take us back to 1673 if my maths hasn't failed me. So that would take us all the way back towards this 1673 level. I mean, that's a very significant decline here. We're trading back within this region here, which has been a prior region of support and resistance for this index. Like I say, that's a massive drop here. That takes us well below even the August lows, when we had that big sell-off in the emerging market currencies, big sell-off in China, and panic throughout the markets. I know we've had a similar period of panic and selling at the start of the year, but already we're almost below these lows. I think this is very significant, and if we can see these levels broken, it could be far more significant again. And if we're taking a look at 2135 back towards, say, 1684, we're actually looking at almost a 500 point sell-off. That is in bear market territory, if I'm not mistaken. Again, apologies if my maths failing me. I'm doing this on the spot while I'm trying to explain these chart movements. That's a very significant move. So I think these levels here are going to be absolutely crucial for me, and I think if we do see a break of them, we could be a lot more pain to come for the S&P 500. Similar signals really in the Dow. This is the weekly chart in the Dow, and let me just go back so we can get more data for these this moving average. This is the ascending trend line, again from financial crisis lows. This one is a far more conventional trend line because we haven't seen any break of it prior to current day, as we had in the S&P, which is why I said it was unconventional. In fact, what we've actually got right now is the third touch of this ascending trend line. The first touch, of course, being the financial crisis lows, the second touch being back in August, and now we are seeing that third test of this ascending trend line. What makes this more important is where this prior levels of support here and also resistance on the way up. What makes it more important, again, this is the test of the 200-week simple moving average for the Dow. Now, this has been important in the past. Back in August, we pulled back to the 200-week simple moving average, and this is where we caught a bid, and this is where we rebounded. If we look back further, we tested the 200-week simple moving average back in August 2011 and October 2011. Now, while we did briefly trade below these levels, we did catch bids, and we didn't see a weekly close below the 200-week simple moving average. Prior to this, we caught a bid again in November and December of 2010. This time we didn't trade below. We actually caught a bid. This was the confirmation of the index moving back into, but effectively moving back into bull market territory. We broke above the 200-week moving average. We got the confirmation here where it found support, and that is where it took off. Prior to this, when we were trading back in April of 2010, this is where we failed to break above the 200-week simple moving average. But again, solid line of resistance. It carries on back.
back in 2008 when we broke below the 200-week simple moving average for the first time in a very long time. We don't have enough data here to show it. But when we broke below here for the first time in a very long time, this was the important confirmation that highlighted to us that there was a lot more pain to come. From there, we sold off another from 11,700 back to 6,500. That's an enormous sell-off, and this was the confirmation that this was potentially going to get more severe. Here we it provided support on the way up, but then we followed that with lower highs being made before the break below the 200-week simple moving average. I cannot underestimate how important this level could potentially be, and if see a break below this, if we see this level breached, we see the previous support breach, we see this trend line breached, this could be a very strong signal that we are headed technically for bear market territory. This is going to be a very important week for equity markets, a very important week for equity indices, and this could be very indicative of how much more pain there actually is to come. Again, we can't really pay too much attention to today's trading. If we did want to pay attention to today's trading, we could see, well, hold on, this is quite bearish because we've seen this prior support retested on the way back, on the way down. It's failed at the first attempt, and we are seeing markets move in decline. That could be seen as a bearish indicator. For me, given that the US markets have been closed and trading volume light, I'm less inclined to pay a huge amount of attention to that. This level though, 15,720 to 15,820. Absolutely crucial for the Dow, and how these markets open tomorrow could be extremely important. How they end the week, even more important. Again, I think this is going to be a very, very big and important week for the US equity markets. Finally, the DAX, and again, it's just not looking very good right now, if I'm perfectly honest. We've got this ascending trend line. Again, this ascending trend line takes us back to the 2011 lows. This isn't financial crisis lows. This is the lows of the Eurozone debt crisis. Now, I can't think of the correct date off my head, but that to me strikes me as being the the famous Mario Draghi moment, the whatever it takes to preserve the euro, when people realised that they were going to do something extreme, that they were going to announce a big as it turns out, it was the OMT program, but this was the indication that there was either going to be a big monetary stimulus package, and instead it was the OMT. This was effectively the line in the sand that they were saying nothing goes below here. We are not going to let yields get to unsustainable levels. We are not going to witness the breakup of the euro at this moment in time. I'm trying to actually get a date on that, because I think it must have been around these lows, 2012. I'm seeing it was around the summer of 2011 though that we did actually see these hints, if I'm not mistaken. Apologies again if I'm wrong, but this is what it looks like. This is just a feeling I'm getting right now. Now we did see it, obviously, of course. We've seen it tested, the trend line tested here in October. We saw it tested here in August. This is the third touch. This is the one that confirms that this is a legitimate trend line. Fourth touch here provides additional confirmation. We traded briefly below here back in October, but then we did see a rebound off here. Now we've seen it broken. So we've seen 5 touches, and now we've finally seen a break of this. This is quite important, if I'm being honest, in my personal view anyway. We saw it touched again a couple of weeks ago, and this is again such a bearish weekly candle, such a large Marubozu candle at the start of the year. Now we did see correction back, but again, look at this. We saw the correction back at the start of the week. We saw a bit of profit taking after that first week, clearly, or a bit of short cover, maybe a bit of short covering. And then we saw it rebound, and this is where we saw the sellers pile in again. We saw the sellers pile in at prior support and around the Marubozu line of this Marubozu candle, and then drove the markets lower, closed below the ascending trend line for the first time throughout this since 2011, closed below this prior support, and now we're seeing this support here, 9,300 come. I anticipate we're going to see this come under significant pressure. We look at the daily chart, again, lighter trading volumes, but the European investors have been in today, so it's important to remember that. It rallied up earlier on in the session. We saw this correction. Again, Friday's candle, big Marubozu candle. We saw it rally up to this Marubozu line, prior levels of support. It got rejected at this level. The sellers came back in, and now we are seeing it trading back towards the session lows, or near the session lows, near the session open. Again, this is just a confirmation of this move below the trend line, confirmation of the move below these prior lows. I think we could be in for, like I say, a very interesting week and a very troublesome week. I think once we get some confirmation in the US markets, we could see a number of very key, important trend lines, key, important moving averages, key, important support levels being broken this week, and that could be a very strong indication that bear market territory is not too far away. For more in-depth news and analysis, check out OANDA Market Pulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.